from the close of trading here in the U.S.
U.S. stocks, little change to marginally lower, leaving the Dow Jones Industrial Average still within striking distance of 20,000.
But the question is, what'd you miss?
In a surprise twist to one of 2016's biggest potential health deals, Swiss company Actelion and U.S. drug giant Johnson & Johnson are back at the negotiating table just a week after ending earlier discussions. We'll take a look at this deal and the future of pharmaceuticals. And the Italian banking system's black hole. While Monte Paschi is not the most systemically important bank, a botched rescue could lead to more worrisome issues for European financials. Plus, why China's bond market is falling out of bed, investors are realizing that despite the government's best efforts to prepare and isolate its economy, China remains vulnerable to a stronger dollar. All right, let's get you started with a look at where the major indexes stand as we head towards the close. Abigail Doolittle has all our numbers. Abigail?
Not a lot of action for U.S. stocks here, Scarlet, going into the close. As you mentioned, we do have the three major averages, the Dow, the S&P 500, and the NASDAQ, all trading ever so slightly lower going into the close, pretty much where they've been all day. Of course, the Dow has failed to achieve, at least so far, Dow 20,000. It looks like that probably won't happen today. And to exemplify just how quiet it's been, we take a look at a chart of the S&P. This is in the Bloomberg G hashtag BTV 2839. The S&P 500 is actually having its smallest trading range day today. We see that right over here, that this is the smallest day all year, competing with April 15th and one day back in July, but really a very tired day. Not too surprising ahead of the holiday weekend. We may, in fact, see a few other days just like today in terms of this quiet trading. As for reasons to think that this could come to an end, maybe not this year. Maybe we do have that tired trading, perhaps a slow melt up into the end of the year. But perhaps in the new year, another chart in the Bloomberg, one that we've looked at before. This is G hashtag BTV 4350. In white, we have the S&P 500 carving out those new record highs. In orange, we have the VIX trading near record lows at levels last seen 2.5 years ago in July of 2014. This sort of a divergence really tells us that investors are becoming increasingly complacent, setting the scene for a possible shock or surprise that could perhaps cause a bit of a pullback for stocks. And one other thing to make note of, suggesting that there could be a bit of a move, a ruffle ahead. When we take a look at a 5-day chart of the 10-year yield, right now the U.S. 10-year yield is on pace for its first weekly decline since the election. Since the election, the 10-year yield has gained an amazing 70 basis points, a very huge move in a short period of time. But right now we are looking at this decline represented in green, because this does, of course, represent that bonds are trading higher. When you start to see this sort of a shift, sometimes it's an inflection point. Bonds, of course, are one of the foundational asset classes, could cause ripples for stocks in the new year, Scarlett and Joe.
All right, something to watch for. Thank you so much, Abigail Doolittle.
What'd you miss? Italian bank Monte Paschi will probably fail to lure sufficient demand for a more than $5 billion capital raise, a situation that makes a state rescue more likely. This is according to people with knowledge of the matter. Meanwhile, Spanish banks may have to give back billions of euros after an EU ruling tied to mortgages. Joining us now with his thoughts on European banking is Benjamin Siegel, portfolio manager of the Neuberger Berman International Equity Fund. Thank you very much for joining us. So, years after the worst of the Eurozone crisis, Italian banks continue to be hobbled by one thing after another. What does the outlook look like for them for 2017?
I think we need, it's binary. We've got one major issue. The issue, as you point out, has been lingering for some time. Other banks around the region raised capital earlier, before the EU rules came in, saying you're not allowed state aid. Now state aid is not allowed, and that's the problem. There's not enough demand from private investors, and EU rules do not allow state intervention. I think this is something of a Mexican standoff between the EU regulators and the Italians. I think ultimately the state aid will be allowed, and the banks will need to be recapitalized. Otherwise, the alternative is pretty calamitous for the Italian banking system. You will see sense prevail, but it's going to be a rocky patch, as it has been for the last couple of months.
In the meantime, the Italian government is taking steps towards preparing for a possible rescue, is looking to ask the parliament to expand public debt. Is there going to be enough demand for that kind of debt?
I think there is. Yields are low, and so you have to pay up a little bit. I think, and as long as the Eurozone holds together, as it looks like it's doing for now, we'll have to see how elections look in as we move into 2017. But I think there is plenty of demand, and I think you do need that Italian sovereign guarantee between the ultimate requirer of the capital, which is the banks, and the ultimate investors. That's why the investors are not going straight to Monte dei Paschi. They want the Italian government in the middle.
Thinking about Eurozone market as a whole, banks obviously played an important role, one, in the facilitation of the real economy, but also when banks fail, that can have major spillovers and cause crises and all kinds of bad things. Thinking about Europe as a whole, how important is it for them to get the banking situation, get some clarity on these questions? I
think it's even more important than it is in the U.S. In the U.S., you've got a very, very advanced bond market, and so companies generally don't need the banks. Larger companies, certainly, they can go direct to investors via the bond market. In Europe, the bond market is far less developed, and so they do need the banks in the middle. So to get corporate capex humming again, you absolutely need the banks.
One thing that's really curious to me is how calm things are in Europe, despite all these negative headlines on banks. I mean, this is the one thing, political risk being on the rise, that everyone keeps talking about, but you wouldn't know it by looking at the VIX of Europe, the V stocks. And if you come inside the Bloomberg here, this is a heat map of the V stocks and how it performs month after month. And again, what we notice is that it's been declining. It's now at a 2.5-year low, and this is even after all the political news of the assassination of Russia's ambassador to Turkey, the terror attack in Berlin. Right now, it's on pace for the biggest drop since 32%. And if you go back a couple more years, it actually goes to the biggest decline, monthly decline, that is ever. Again, down 32%. In general, this tends to be a pretty low vol month for European stocks. Why do you think that is? Why are we able to shrug these headlines off?
I think a couple of things. One is you've got a weak euro, you've got a strong dollar. I think you've been talking about with reference to your China piece. A strong dollar is obviously challenging for the U.S. Because it makes U.S. exports less competitive. It's obviously incrementally positive for the Europeans. I also think you've got elections and you've got some sort of instability there, but it's only very regional. And the whole point of the EU is all these countries coming together. So one election or one by-election in a certain geography doesn't necessarily, and certainly doesn't immediately, destabilize the entire system in the same way that the U.S. election clearly has a transnational, countrywide implications for the U.S. One election in France clearly affects France, but there's a limit to how much the French government can do because you are part of the EU, and clearly it ring fences whatever issues there are to France with limited implication for the rest of the Eurozone. So when you've got companies that are operating across the continent, and the stock market that obviously represents overall the overall European economy, I don't think those individual events in the context of Europe really sort of undermine that fundamental factor of the weak euro.
Obviously, we've been talking about Italy a lot all year, basically, last year too. Today, however, we got this ruling relating to Spanish banks, which fell on news that they were going to have to pay back some mortgage payments to customers. How's the Spanish banking system? How healthy is it in your view?
I think it's relatively unhealthy. You've still got a lot of bad debt mortgages of dubious value on the balance sheets there. We have had investments in Spain, but more the Spanish banks that have operations in Latin America outside of Spain. In some, as we looked at it, that's the cheapest way to access, the most cost-efficient way to access the opportunity in Latin America. But the underlying fundamentals in Spain, although you've got a little bit of an economic recovery, don't look that good to us. And the risk that you have with banks not as profitable as they are in other parts of the world, in the UK, in the US, there's better places to put capital.
So when you look at the Spanish banking problems, it's not really comparable to Italian banks. Is it more like the U.S. banks after the housing crisis?
Yeah, I think there's the Italian banks have a capital problem as well as an asset problem. I think the the Italians, the Spanish have raised capital, and I think you're looking more at an asset problem. And if you get growth, that ultimately will rectify. But you do have one of the major market effects that you were talking about earlier, with bond yields having risen, obviously declined only this week for the first week since the election. Rising bond yields will be positive for bank profitability, but rising bond yields happen first here in the US and only secondly in Europe. So the outlook for banking profits in Europe, in the Eurozone, countries using the euro, is much less compelling.
Meanwhile, we have some headlines
Perfect
from
timing.
Monte de Paschi. Speaking of $2.45 billion of bonds for equity swap and 2 offers. Also says they've got 1.39 billion euros from institutional investors in 2 offers. So we'll be monitoring these headlines relating to a Monte de Paschi capital raising swap. Benjamin Siegel, Neuberger Berman, thank you very much for joining us.
Thank you.
Coming up on What You Miss, we'll talk oil prices with Michael Cohen, Barclays head of commodities research. This is Bloomberg.
All right, we have some breaking news. This is from the Wall Street Journal. Carl Icahn is being named a special advisor to President-elect Donald Trump on regulation. He will also advise on the selection of the next head of the Securities and Exchange Commission. So again, according to the Wall Street Journal, Carl Icahn is being named a special advisor to Trump on regulation. He will also advise on the choosing of the next SEC head. If nothing, Carl Icahn has been extremely vocal about what regulations he thinks the government should get rid of.
Right. He's talked a lot about this. He talked about issues related to ethanol. He was obviously a big Trump supporter for a while. He even made a bunch of money trading on the market the night Trump won when there was that initial sell-off. So now, obviously, going to have a more formal role advising the new president.
He definitely has skin in the game. All right. Once again, Carl Icahn, according to the Wall Street Journal, being named special advisor to President-elect Donald Trump on regulation. He will advise on the selection of the next SEC head. What'd you miss? Stephen Whiting, the global chief strategist at Citi Private Bank, is still with us to talk about his risk outlook for the global economy. And I want to bring up this chart here from Mike McDonough, Bloomberg Intelligence's global director of economic research. As we close out the year, the odds of recession are holding steady and actually falling across G7. The UK is the blue line, and we've actually seen the odds drop by almost half since it peaked at 48% in August, and the data has been better than economists had been anticipating. You also see Japan coming down to 20%. That's the red line. The U.S. has held steady at 20%. Europe has pretty much held steady for most of the year at 15% as well. And, of course, these are all recession forecasts based on the consensus of economists surveyed by Bloomberg.
So take a look at those when you actually are about to approach a recession but are not yet in them. They tend to stay quite low. You know, recessions do sneak up a bit.
They sneak up. You don't have a head like.
Well, look, there's usually some
pre-warning.
significant excesses. You know, folks tend to be very, very bullish, and there are some vulnerabilities. You've built something up. There's something to recess. I think we became more optimistic about the U.S. this year. I mean, for 6 out of 7 years, we saw terribly poor labor force growth out of the U.S. And in this year, it came back to life. Over 2 million people joined the labor force. It didn't require us to dig deeper and deeper into our existing resources to grow as we have. If that can continue, and I think that there's a good chance that it can, and if we can come back from what have been the poorest productivity growth rates we've seen in 35 years, then, you know, putting fiscal stimulus late in an economic recovery is an experiment that I think can work. It could work for some time. So
could we, I mean, this is already one of the longest U.S. expansions on record. Could this go on, say, another 2 or 3 or 4 years, theoretically?
Well, I'd be careful. The things that really boost demand in the economy have to be matched by supply. And if you end up with, you know, sort of a boom-bust type profile of policy, you get that bust later on. But you can certainly change the contours. And, you know, a mild recession not so far out can turn into a deeper recession after a couple of years.
I want to ask more about the productivity. It's been such a riddle. We can't really figure out why we can't get it going. Is it just us? I mean, do we see this around the world as well, this slump in productivity?
Throughout OECD, where you could measure it, it's been very weak, and we don't quite have all of the history there. I mean, if you think about this recovery, it has been profit strong, fairly decent on headcount, and poor on GDP growth. And, you know, we've seen periods in the past where it just seemed like there was a lot of innovation, but it wasn't getting measured in the economy. As I see it now, we may be on the cusp again, where some things that, you know, just allow us to make more with less. It may not help employment growth unless there's a real demand rev up, but it could mean that we get a faster speed limit for the American economy if we can put these resources to work better.
In the press conference last week for the Fed, Janet Yellen, back in October, she had given this speech about proposing more research be done on the merits of running a high-pressure economy. Essentially letting the economy run hot for a while, maybe reversing some of the hysteresis that we've seen since the financial crisis. In the recent press conference, she walked it back. She said, I was just talking about maybe the need for more research, not necessarily that this is a good idea. Either way, do you think there are merits to that perhaps that if the economy were to run hot for a while, for years, that would cause new investment and maybe snap us back out of some of this productivity loss?
So this is to be seen. I mean, it absolutely is to be seen. I mean, you know, fiscal policy out of Republicans and Trump, you know, look to do several things. Drop corporate tax rates, make adjustments in sort of, you know, who wins and loses. We'll set that aside for now. repatriate foreign earnings, a bunch of things that have had small impacts in the past, but there is such a long list of things. If you're simultaneously stoking consumer demand, I think we can move the needle. It's a little bit like QE. We moved mountains of financial assets to move the economy a few inches. In fiscal policy, I think that there's going to be a lot, or there could be a lot, and you'll see some effect in the economy, but it may be 3 percentage points of GDP to get 1 percentage point out of growth out of the economy.
So it's the volume of the policies that are being proposed right now that could move the needle. What about in Europe? I mean, we've seen the economic data across the world improve. It's been looking better in terms of beating estimates.
Yes.
What's the likelihood of productivity actually moving to the point where it's going to affect GDP in a positive direction?
Well, there are certain things, like, for example, how e-commerce, 7 years ago, it was the same size as like the department store sales segment. Now it's 3 times the size, but employs 1/4 the number of employees. Now, these sorts of things that shed labor or labor demand, you don't look at that as being good for the industry. But that is some level of activity you can have, and you can use those human resources elsewhere. Now, it's not an easy story for everyone, but we are seeing, for example, that in Europe, they could be following the U.S. on this. And so it is possible that some of these technological breakthroughs that can boost economic growth can be transplanted.
Speaking of Europe, more elections coming up this year.
Yes.
France is the big one. Also, Netherlands is going to be pretty important. The lesson of 2016 arguably was markets don't really care about elections that people get hyped up about. Is that a lesson to take into this, or are there still real political risks out there?
I'm a bit more cautious. And look, there's plenty of upside for still depressed Europe with the support from the central bank, with relatively low valuations, if they run this political gauntlet very well. And, there's been no reaction to some adverse votes from the way people thought recently. But can you say that cooperation in Europe just doesn't matter when you have a common currency zone with $9.8 trillion in euro debt? Look, I think that you could overrate the risks very easily. You could over-exaggerate it, but the market is not terribly worried about that now. And so I think you can get some level of concern heading into the next several elections in Europe into the spring.
All right, Stephen Whiting, Global Chief Investment Strategist at Citi Private Bank. Thank you very much.
We have more breaking news. Bed Bath & Beyond coming out with its results, and its sales unexpectedly dropped. Third quarter comparable sales, that is, for the period. Profit also missed analyst estimates as well. 85 cents was the reported EPS. The consensus estimate was 98 cents. And when giving its outlook, Bed Bath & Beyond said its full year 2016 earnings per share estimate is at the low end of its forecast.
You see the stock getting slammed pretty hard there after hours, down 5% with this lower than expected outlook.
Coming up, the anxiety that's gripping China's bond market showing no signs of spreading to equities, at least not in a big way. We're going to show you the chart behind that. This is Bloomberg. All right, we have breaking news from Red Hat. The shares are plunging in after-hours trading. The CFO is stepping down. He's going to accept a CFO position at another company. Red Hat currently off by 13% in after-hours trading. You can see also as well that third quarter revenue missed analyst estimates as well. And for the fourth quarter, it sees revenue of anywhere from $614 to $622 million. That, too, missing the consensus estimate of $638 million.
Yeah, down 13%. Of course, this is a stock that's up tenfold since the financial crisis, so it's done extremely well. But obviously, on this news, you can see the revenue coming in shy of expectation. Stock getting clobbered pretty hard after hours.
And we should mention third quarter billings growth as well, 9.5% increase. Analysts were looking for an increase of 14.1%, so missing on that measure as well.
What'd you miss? Gold holdings have dropped 28 days in a row. Let's take a deep dive into the Bloomberg. You can find all the following charts using the function at the bottom of the screen. Just look at this chart of outflows. This is gold ETF holdings total, all the different ETFs that hold gold. The last day that there were inflows into gold was November 9th. So the day after the election, a lot of people were probably still saying, oh, Donald Trump's going to be good for cause nervousness.
Right.
Donald
Recession,
Trump adorns lots of stuff in gold personally, so we should probably go along. All the strategists were saying to go along gold because of Donald Trump. Of course, everything the strategists have said has been largely incorrect in terms of the market reaction. Nonetheless, we see massive outflows every single day since the election. There have been outflows from gold ETF holdings. You know, it's a similar story with the sell-off in treasuries.
Yeah.
Anything that's deemed to be safe haven-y, anything like that, has done pretty bad since the election.
Well, you can't generate income. You can't get any yield from gold.
There's no, right. It's negative yield because you have to pay for storage. And so gold inherently has a negative yield. It's a hassle. And so, yeah, if you're selling stuff that has low yield, then you really don't want to have stuff that has negative yield.
I like how you linked it with Donald Trump liking gold.
Yeah, I mean, he likes gold. It seemed like it'd be a thing.
No, I applaud that. All right. I'm taking a look at something that we've been talking about for a while, or I know you've been curious about, which is the turmoil in China's bond market. It isn't really spilling over into equities in a big way. So the blue line is the 10-year yield on China. You can see it's spiked up, right? The white line here is the 3-month implied volatility on the China ETF FXI, which is listed in the United States. It tracks the biggest Chinese companies. And, of course, you've seen that hold pretty steady. So what's going on? We know that Chinese policymakers are actually trying to tamp down the leverage in the Chinese bond market, right? They want to tighten conditions a little bit here and bring down prices, and that means higher yields as a result. But equities kind of shrugging it off completely.
Yeah, you know, it's there's so much talk about the degree to which the government tries to regulate and control these markets. You wonder if perhaps the bond side is about cooling that real estate. Meanwhile, we have an official statement out of the Trump campaign saying that Donald Trump will be, or Carl Icahn will be a special advisor on regulation. Donald Trump says, Carl was with me from the beginning, and with his being one of the world's great businessmen, that was something I truly appreciated. So Carl Icahn being in part rewarded from being one of the early backers of Donald Trump. Coming up more on What You Missed. We'll be back with What You Missed. This is Bloomberg.
I'm Courtney Collins. Let's get to Bloomberg's First Word News this afternoon. Boeing CEO Dennis Muilenburg told President-elect Donald Trump today that his company can build a new version of Air Force One for less than $4 billion. Trump had criticized the cost of the plane.
We're going to get it done for less than that, and we're committed to working together to make sure that happens. And I was able to give the President-elect my personal commitment on behalf of the Boeing company. Yeah, this is a business that's important to us.
Lockheed Martin CEO Marilyn Houston, who has also been criticized by Trump, will meet with the president-elect later today as well. That's according to aides. Meanwhile, vacationing President-elect Trump came outside at his Mar-a-Lago estate in Palm Beach, Florida, a short time ago to speak with reporters. Here's his comments on the attack in Germany.
It's not an attack on humanity. That's what it is. It's an attack on humanity. And it's got to be stopped.
Mr. Trump said his comments about terrorism and his idea of a Muslim registry have been proven right. He also said he has not spoken to President Obama about the attack in Berlin. President-elect Trump has chosen Peter Navarro to lead the National Trade Council. He was an economic advisor to Mr. Trump during the presidential campaign and also a professor of economics and public policy at the University of California, Irvine. Mr. Trump plans to create a National Trade Council inside the White House to oversee industry policy. And a spokesman for Russian President Vladimir Putin is suggesting that Moscow doesn't believe the man who killed Russia's ambassador to Turkey acted on his own. But he refused to offer theories behind the assassination. Andrei Karlov was killed Monday in front of stunned onlookers at a photo exhibition in Ankara. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Scarlet?
Thank you so much, Courtney. Breaking news, President-elect Donald Trump announcing that Carl Icahn will be helping him out as a special advisor on issues relating to regulatory reform. So once again, President-elect Donald Trump announcing that Carl Icahn will be serving as a special advisor. This is not a cabinet post, so presumably no nomination process, no confirmation process is needed. Mr. Icahn, of course, a noted investor, has lots of money at stake in industries, including energy, that are currently under regulation, and has made his view very widely known.
Yeah, it'll be interesting to see how that is dealt with.
Yes, potential conflict of interest, but maybe they'll get that resolved. Meantime, Red Hat shares are plunging in extended trading. Its fourth quarter revenue outlook missing analyst estimates. Also, the CFO is leaving the company. He's accepted a CEO position at another firm. So Shander will be named CFO pending permanent replacement decision. And when I look at who Chandler is, that is probably the, you know what, I'm looking at the MGMT function here on the Bloomberg, and Frank Calderoni leaving the firm. They will have a temporary CFO in the meantime.
Meanwhile, shares of Bed Bath & Beyond falling after the company came out with Q3 net sales that were below the lowest end of the range. Net sales for the quarter, $2.96 billion, well below estimates and well below the range. The lowest of the range was $2.97 billion. It sees full year 2016 at the low end of estimates. Q3 EPS, 13 cents below estimates, so pretty ugly all around, and you see the shares are down just under 4%.
And Micron, the memory chip maker, rising 7% in extended trading, and sales forecast topping analyst estimates on demand for chips for phone and computer parts, and that's starting to outstrip supply. So you can see there, Micron up by better than 8.5% in extended trading.
What'd you miss? For much of the year, Stephen Roach, senior fellow at Yale University's Jackson Institute, has said the U.S. economy is in a, quote, balance sheet recession. Consumers, he says, have remained unwilling to really spend money. The pattern has not allowed the economy to recover fully since the 2008 financial crisis. On Bloomberg Surveillance today, he was asked if the American consumer is still struggling.
It was a balance sheet recession that occurred in 08 and 09 that left overly indebted, savings-short consumers in a horrific hole, and they're digging out. I mean, the debt-to-income ratios are down. The savings rate is still low, but it's higher than it was. But, there's still more work to do, and so it's key to focus on balance sheet repair in the quarters and years ahead in the new administration.
Stephen, will Donald Trump make the American middle class great again?
Well, Well, Guy, he would certainly like to, but it's going to take more than just a politician to transform the rough dynamics that are bearing down in the American middle class. The president-elect is focusing, to his credit, on jobs, but to get jobs growing again is going to take more than a phone call, more than a threat to bring workers back from offshore. We have fundamental problems that have been bearing down on the manufacturing sector and other sources of job creation for a long, long time. And for an administration that wants to now be muscular in using trade policy to bring jobs back home, that could really backfire, because to turn protectionist at a time when our budget deficits are going to get larger and our trade deficits for macroeconomic purposes are likely to get bigger, that's a big disconnect that could have significant implications for the U.S.
Do you get a sense, though, that the policies that are being talked about thus far are regressive, progressive? Kind of what is the mix there in terms of the way that income distribution is going to be during the next 4 years?
Well, income distribution is just not an active consideration by the incoming Trump administration. In fact, that was characterized, rightly or wrongly, as one of the flaws in the Obama administration. And they're going back to classic trickle-down supply-side economics, with tax cuts skewed more to those who they perceive to be at the heart of the job creation.
What's your experience on trickle-down? What is the Roach report on the efficacy of trickle-down theory?
The drips were a lot smaller than we thought, Tom, and it trickled, but not nearly enough to make much of a difference to the median worker whose real wages didn't grow at all.
We're going to talk to you about China. I want to talk about this almost as a domestic issue. You got a great quote, classic Roach, a bilateral fix to a multilateral problem.
No such thing.
If our president-elect is a deal maker, he loves to do deals. I think we can all agree on that from the history we know of President-elect Trump. A deal maker doesn't do multilateral, do they?
A deal maker does it, one transaction at a time, one partner at a time, and really doesn't have a big appreciation of the big picture. And the big picture is what's hurting the United States right now in the world economy.
Let's bring up a chart, Dr. Roach, here of China and the ebbing of GDP. You have been the most critical economist of the concept of hard landing. That is not a hard landing, isn't it? Moving from 7% up to a booming 10%, and the 5-year moving average moving down to a lofty 6 to 7%. That's not a hard landing, is it?
No, Tom, this is a conscious effort on the part of China to rebalance away from hyper-growth and manufacturing-led exports and investment to more moderate growth and services-led consumption. They're in the early stages of this transition. If they're successful, and I remain hopeful that they will, growth will slow further, but it will be more sustainable, be more balanced, and set them up, I think, for a much stronger economy in the years and decades ahead.
What is the gloom crew, the Roach critics, what do they get wrong about China?
They're looking at China through the Western lens, a debt crisis a la Japan. This is the standard view of China right now. They have been on a huge debt binge. They need to wean themselves from debt-intensive growth. But they have a lot of savings, double the savings rate that Japan has, so they owe their debt to themselves. And the key challenge for China is to make certain that loan quality in the banking system gets addressed, and that they progress ahead in managing this transition.
Jonathan Spence of Yale University, the Great Khan's continent. And China is a continent. I mean, the mass and the scale there is there. What is the partition right now of Pacific Rim China from the rest of China? Is it coalescing, coming together, or is it ever apart?
Look, China's been seeing a lot of its economic growth and development concentrated in eastern coastal China, but they've been spreading the development out into central China, especially, gigantic cities like Chongqing and Chengdu. I mean, Chongqing has a metropolitan area of 35 million people, Tom.
So it's twice the size of New York.
Exactly. And growth is taking advantage of cheaper labor and greater connectivity. I mean, they have infrastructure that connects central China to coastal China that we would die for in this country, having just suffered whiplash coming down the East Side Drive to see you this morning.
Stephen, does the next generation of politicians see the same China as the current generation of politicians?
The next generation guy in China or in
Yeah, in China. In China. Because next year is going to be a pivotal moment politically for the Chinese.
Well, it is. But, you know, look, the next generation of politicians in China is the current generation. Xi Jinping is not going anywhere. He will bring in a new leadership team, but they're tightly aligned with his thinking on, you know, the rebalancing toward the services and consumer-led economy. I don't look for any fundamental shifts in policy in this next party Congress.
We've got 20 seconds. Should Mr. Trump travel to Beijing, first order condition?
I think he needs to get a deeper and more personal appreciation of the challenges.
Mm-hmm.
I would welcome the chance to have the president-elect make a trip to China and see what's going on elsewhere in Asia.
That was Yale University senior fellow Stephen Roach.
Coming up, Rite Aid stock soars this week as Fred's makes a deal for more than 800 Rite Aid stores. So next up, we'll tell you why the deal's a major piece of a bigger M&A puzzle. This is Bloomberg. I'm Scarlet Fu. What'd you miss? Rite Aid stock got a huge pop this week, rallying the most in a year. And that was after the pharmacy chain, which is in the process of being acquired by Walgreens, agreed to sell 865 drugstores to Fred's for $950 million. So let's dig into why in today's The Numbers Don't Lie. Physical stores are at the center of antitrust concerns since Walgreens announced its intention to buy Rite Aid in October of 2015. And you can see the extent of store overlap between the pair in states from California to New York to Michigan and Ohio. So Rite Aid's plan to sell stores to Fred's is designed to help ease those concerns and is still subject to FTC approval. Fred's, which is a chain that's in the Southeast, has agreed to buy additional stores if regulators want more divestment. Now, you can see here how Rite Aid has steadily decreased its store count over the years since 2008. As for that original Walgreens and Rite Aid tie-up, both sides had agreed to as many as 1,000 store divestitures. Walgreens would owe Rite Aid a $325 million termination fee if the deal's not approved, and also $650 million if Walgreens enters into a, quote, parent-permitted transaction, which, by the way, isn't actually defined. Now, Walgreens' bid follows a multi-year effort by Rite Aid to revive its stores. And you can see how in the most recent quarter, Rite Aid's comparable sales, that's the orange line, has fallen 2.5% on the back of a 3% plus decline in pharmacy sales, which is the white line. Prescription sales also declined as well, the blue line. Now, the rapid consolidation of the healthcare industry, from drug makers to managed care companies, is driving a race to achieve scale in the supply chain. When completed, the Walgreens-Rite Aid deal would be the biggest in its space. And of course, we'll be looking for details on how that deal is pending when Rite Aid releases earnings before Thursday's U.S. opening bell. Joe?
What'd you miss? Swiss biotech company Actelion has turned back to prospective bidder Johnson & Johnson for exclusive talks about a, quote, strategic transaction. The move is an about-turn that appears to sideline rival suitor Sanofi. Joining us with the latest is Bloomberg News managing editor for Global M&A, Jeff McCracken. Jeff, thank you. So This is a real surprise because there were talks of Actelion and Johnson & Johnson being together, then they collapsed, then a few days later they're back. Why is this back?
Because Actelion wants it back. So the reality is, roughly a week or so ago, Actelion went to J&J and asked them to bump their offer, which we have now determined was around $260 a share for Actelion.
Okay.
But they couldn't come to an agreement. I think J&J felt like $260 was a pretty fair offer. They weren't getting the exclusivity that they were hoping from Actelion, so Actelion turned to Sanofi, who they knew was out there. We had reported Sanofi had hired a bank. They had let Actelion know of their interest. Those two talked for 4 or 5 days, and a lot of that conversation was about a CVR. So that's a contingent value right that you earn over time if the drugs hit certain goals. But it was very complicated, to be honest. And most of the shareholders at Actelion preferred the offer that they knew J&J was willing, probably an all-cash offer, $260 or more a share. So in the last few days, Actelion let J&J know, listen, if you come back, if you bump your offer, we'll make this exclusive.
So what does Actelion have specifically that's so appealing to J&J?
One of the main things is they've got a drug for a form of hypertension that for J&J would get them into a new area. It would be into a disease area, if you will, that they're not already in. And from J&J's perspective also, they have a lot of offshore cash. There's a lot of money sitting over there that they would like to spend, before any kind of repatriation comes along, probably next year under a new administration. So I think those are two of the things that are going on from the J&J perspective. And their shareholders understand this is the kind of thing that J&J is going to do. They're not going to risk themselves. They're a very solid company. I think they got one of the highest credit ratings that exist. But this is the kind of deal that makes a lot of sense for them, especially in Europe.
There's nothing to do with tax inversion or a lower tax rate or anything?
Oh, good. No. You're not going to see J&J invert. I think the inversion run has probably gone, to be honest. I don't think we're going to have that issue, especially if we get the big tax reform that people are talking about for next year. You're going to see lower tax rates for corporations. I think you're going to see repatriation, which will have a lot of interesting impact because you might not see as many U.S. companies going into Europe. Companies like Facebook or Microsoft or J&J are sitting on billions, tens of billions of dollars. GE, they use that money often to go after targets in Europe, not to change their tax basis, but just to use the money that's sitting over there.
Do you see bankers overseas trying to get deals done or pitch deals before that theoretical source of demand for companies goes away?
Yeah, I do think you're going to see that. And then, say, 6 months or so from now, I think we're going to see more U.S. companies. They'll take the money that they repatriate and they'll increase compensation for their executives. They're going to increase dividends, buy back shares, and I think they'll spend some of that money on M&A here in the United States.
So what does Sanofi do now?
Poor Sanofi. Because in August, they got somewhat blindsided. They were after this oncology cancer drug company called Medivation. And they were in talks that they thought were exclusive. And Pfizer, another very big U.S. company, kind of came along and beat them badly. And then they went after, they're going after Actelion, and they're probably going to lose out here. There are a couple companies out there. Scarlet and I were talking earlier on an earlier segment. There's a company called Regeneron, which Sanofi owns, I think, 22% of. That could be something that makes sense for them. There are a few others out there. We're going to see a lot of healthcare M&A next year. That's certain.
How urgent is the need for a Sanofi or a J&J to acquire other companies to get these specialty drugs?
It's not urgent. It's not like there's anything that's going to happen in a quarter or two. But Sanofi has a lot of drugs that are either, where their generics going to come in, or others have come in and kind of taking some market share. I think in the next couple of years, Sanofi is going to have to do a very big deal. They were hoping, Actelion would be it. Before that, they hope Medivation. I wouldn't be surprised if next year we're here again talking about some deal Sanofi's trying to do.
So far it's 2 strikes.
Yeah, 0-2 right now.
Jeff McCracken, thank you very much.
My pleasure.
Coming up, how Obamacare and Trump's threat to repeal Obamacare has affected the healthcare industry in the past year, and what we can look ahead to in 2017. From New York, this is Bloomberg. What'd you miss? Bloomberg Intelligence recently released its 2017 Global Healthcare Outlook. And every day this week, we're taking a look at what you can't miss in different sectors in 2017. Joining us now is Bloomberg healthcare analyst Jason McGorman. And Jason, let's start with Obamacare, because if Trump does repeal parts of Obamacare, there are certain to be winners and losers. Do we presume that insurance companies will be one of the winners because they have already dropped out of so many of the exchanges?
No, it's a good assumption. So in the near term, actually, it is a win for them because most of the diversified insurers have been losing money, as you've heard. But a handful of them, like Anthem, Insignia, are still in the exchanges for 2017. So for them, it actually could be welcome news because they've been losing money. But in the longer term, they do lose some potential revenue and earnings. But for hospitals, they lose insurance coverage and some earnings potential. So for them, it's a negative.
Now, obviously, every Republican basically wants to repeal Obamacare, but there's a lot of disagreement about how that's done. If you sort of rip it out right away, you create all kinds of disruptions. How much of a fight is there going to be about the exact steps to repealing Obamacare? And which side will the sort of hospitals and healthcare companies, they almost have different visions for how best to do it?
Yeah, no, that's very fair. So Centene is one of the insurers that had an investor day just last week, and they were talking about Medicaid at the state levels being very complex because each governor might have their own agenda, right? So you could foresee this as being very complex because 2018 you have elections where people have to run again, right? So do you want to do this all in 2017 and 2018? Or do you want to, what Centene thinks might happen, extend it a little bit beyond the election and take a little bit longer so maybe investors shouldn't be quite as concerned in the near term?
So things could be status quo for a number of years, potentially 3 years before anything is actually done. Are investors getting ahead of themselves now by trying to, oh, you know what, we have some breaking news right now. Let's head over now to Florida, where President-elect Donald Trump is coming out. He had been meeting with a number of military generals. So he's been meeting with folks already because he's on holiday in Florida, and he held a national security meeting. In the interim, we saw that he spoke with the CEOs of Lockheed Martin and Boeing as well.
Right. Earlier, we got, of course, that commentary from the CEO of Boeing about the plane. Now, as you can see, a lot of decorated military officials coming out of, there they are in Palm Beach.
Yeah,
we'll see. I think we expect Donald Trump to say something to the press, though.
Perhaps. It's unclear. He kind of improvises as he goes along. Let's listen in.
Primarily the F-35. We're trying to get the cost down. Because it's a program that is very, very expensive.
Do you certain security concessions from the Lockheed CEO who's here a few minutes ago?
Say it?
Do you security concessions from Lockheed Martin?
Well, we're going to see. We're going to see. Just beginning. It's a dance, you know. It's a little bit of a dance. But we're going to get the cost down, and we're going to get it done beautifully, and these are great people. These are amazing people.
And your conversation with Boeing.
And I'm very impressed with them. And good negotiators, too. Good. Good, Chris.
And your conversation with Boeing seemed to produce some positive results?
I think so. We had the chairman of Boeing, CEO, and I think we're looking to cut a tremendous amount of money off the press. Okay? Thank you, everybody. You comfortable? Everyone okay? Not bad, right? Not bad. Thank you. Thank you. Generals, thank you.
And again,
thank you very much.
President-elect Donald Trump, after meeting with his advisors or attendees at this Pentagon meeting where they discussed national security, he said he's trying to get F-35 costs down. He also says that the military officials he met with are amazing. So let's go back to our guest right now. Jason McGorman of Bloomberg Intelligence. You were talking about healthcare and Medicare.
Yeah, so I think one of the longer-term opportunities, though, regardless of what happens with Obamacare, is that, you know, costs continue to rise, and some of these providers of outpatient centers have a real opportunity because hospitals, the costs are very high there. So actually, earnings growth for some of these providers looking more like 15% in 2017. So that's an area that we think is underappreciated by investors amid all the noise.
What about medical device makers? How have they fared under Obamacare, and what are the risks as Obamacare might go away?
Sure. So I'm sure you've heard they've made a lot of noise about the device tax. They've fought it probably the hardest out of anybody. And so this year, in 2017, they don't have that. And they will tell you that they have not gotten a major boost. But I think that they have. So there may be a bit of a mix, but they're hoping that Republicans will repeal that tax and that they'll have more money for innovation and jobs. So on the whole, it may be a slight positive for them. But longer term, maybe fewer patients that have coverage.
And final question to you, Jason. What about drug pricing? Because Donald Trump in a tweet has indicated that prices are too high. Previously, we thought it would be Hillary Clinton who would be, really pressing down on this. But it appears that this is going to be an issue here with Trump.
Yeah, what I could say with that is that you have a number of players involved that are going to lobby pretty heavily against that. But of course, the government's going to push to keep costs down.
All right, Bloomberg Intelligence's Jason McGorman, thank you so much. And of course, you can read Jason's research on BI Go.
That's all for What You Missed. Thanks for watching. Lots of economic data coming out tomorrow, including GDP. Have a great evening. This is Bloomberg.
I'm Courtney Collins, and you're watching Bloomberg Technology. Let's start with a check of your first word news. Germany says the Tunisian suspect in the Berlin fatal truck attack was under covert surveillance for several months. Authorities are offering a reward of $105,000 for the arrest of 24-year-old Anis Amri. A wanted notice for Amri says he should be considered armed and dangerous, and that he has used various aliases. Germany also says that it rejected an asylum request for him in July. Meanwhile, the president-elect declared a deadly truck assault on a, quote, attack on humanity. He spoke to reporters before a Pentagon meeting with retired Lieutenant General Michael Flynn, his incoming White House National Security Advisor. Peter Navarro has been chosen to lead the National Trade Council for the incoming administration. Navarro was an economic advisor to Mr. Trump during the presidential campaign, and billionaire Carl Icahn will be